How's it going? How's it going? Yeah, welcome aboard. It is I, your boy TJ, coming out straight live from M5 for the addicts. Again, hanging out with my co-host from the property space and the text and property. Same thing. Hey, Lebo, how's it going?
I'm all good. I'm all good. How's it going, TJ? How's it going, guys?
Yeah, we're going strong, man. We're going strong.
Yeah.
It is good having you around. And what's been happening in your space?
No, I've had a good week. We've been making some few waves, finalizing these year's projects, raising capital for the last project of the year,
Yeah.
and preparing for the following year, starting from now. So we still prepare for the next year, so that when we come back from the festive, we are ready and strong.
Awesome. That's good to
Yeah.
hear. That's good to hear.
From your side, how's it going? What has it been?
This week, we just closed out the fund that we were busy with, and we've raised a bit of capital there. And you know, when you've got cash, it's good to go out into projects. And again, that's preparation, kind of like 2021. But I had a few projects that were stalling, so I've just now closed all of those projects with the cash that we've raised. And that's one skill, right? I mean, when you go into some of these seminars for properties and things like this, I think the one other thing that they forget to mention in there is that raising finance is one of those key things that you need to have under the belt, eh?
Yeah.
Yeah.
You need to build some form of systems that can, continuously raise capital for you.
100%.
Yeah.
Awesome stuff. Shall we go into the tax and property and tax to make sure that, we are talking about what we love talking about, right? So today we wanted to talk about something that's pretty interesting. It is a fact that Lebo is going to die. And it is a fact that I am also going to die, right? But Lebo, I'm a father. I've got 2 kids, beautiful wife. And I just want to make sure that whatever I am doing, my wife and her Benten, they are not going to be reaping the benefits of this, right? Maybe more especially her Benten. My wife, I'm okay for her, but her Benten, when I'm dead, I'm not happy with that one, right? But on a serious note, we are all going to die, and we do what we do because we are always talking about legacy, and we are always talking about your kids can inherit this. But is it really true, Lebo, in terms of the structures that we have and what you are seeing in the communities, people are actually buying properties? Is it really true that we are actually building the legacy?
We are building legacies. However, what most of people are, the mistakes that they're doing is they forget to do structure planning when it comes to their wealth creation plan. They forget to do succession plan. They forget to plan for after death. You accumulate, a lot of people, they get it right on the side of accumulating those assets and accumulating wealth, but they forget to do an estate planning in terms of succession plan. When they have left this world, what would happen to their assets and how much taxes it attracts? How are they going to, those assets going to be transferred to their wives, to their kids, to their, all the dependents or beneficiaries of their estate. So they don't consider doing an estate planning whereby they plan the succession plan. They put a structure in place that will allow them to achieve their goal. Yes, they have accumulated these assets, but what does it entail when they pass on, when they are no longer on this earth? what would happen to those assets. So yes, we are building wealth, but we forget, sometimes most people forget to put a structure that will be beneficial for their assets and their beneficiaries,
Yeah.
or their dependents that will get those assets.
So, Lebo, me and you, we are young hustlers. You're in your late 20s. I'm in my late 30s. And between the two of us, we're pretty young, man. We're not going to die anytime soon.
True. But the opposite can also be true. I mean, naturally, we might assume that we might take longer, but anything can happen. No one knows, their appointed time. I mean, their appointment with death. So you can wake up. We're taking a risk every day when we wake up. We don't know, because tomorrow is not promised to
Right.
anyone. So we might think, because that's what the mistake that most people do. They assume that they still young, they still have a bit of time on this earth, so they still have a lot of time to plan, and then they don't put those plans in place until it's too late. So yes, we're still young by mortality rate. Yes, it still gives us, a bit of more years,
Right.
the probability of living longer. But the reality is, we don't know how long we're going to be in this earth.
We Lebo, you've got a car, I've got a car. Hopefully, both of us will be in the private jet soon. But we're still flying with the public airlines. And,
Yes,
and
yes,
in my thinking, there, Lebo, is statistically they say that in South Africa there is seven. I think the last stats that I saw was there is 7 people that die on the streets every other minute
yes,
on the
yes,
streets,
yes,
right? So obviously
yes,
the numbers spike up during holidays, but it's not happening every day. But statistically, that's what they say.
yes,
Me and you are on the streets every day,
100%.
right?
Yes,
Me and you can be that number, right? It's pretty much possible. I suppose what me and Lebo here are trying to drill down to is you can be doing all of these things that you're doing, but death could be around the corner. And if you do not sort out your stuff correctly, there is repercussions to it. And this is the point that we want to discuss today. Lebo, I
yes,
want to come back to the point where you spoke about wealth creation plan. Let's
yes.
dive into that a little bit. Let's unpack it. What is it?
So basically, wealth creation plan or succession plan or estate planning, it's basically you putting a plan and a structure behind your assets and the wealth that you have created for yourself and for your loved ones. So it's basically you saying, look, I am buying assets. So, but when I'm buying assets, I'm intentionally putting a structure to it because of certain, succession plans that I have in mind. For instance, if you are buying asset in your name, then obviously should it happen that you die, uh, now it attracts your estate duty, it attracts your capital gains tax. So as a result, your beneficiaries or your loved ones are not going to get what you think they're going to get, right? Like for instance, estate duty, it attracts 20% for assets lower than 30 million and 25% for all the assets that are above 30 million. So that shows you that you're already losing up to 25% only on estate duty when they transferring your asset, when they winding up your asset to in order for them to transfer it to your loved ones.
Mm,
So buying asset under your personal name, then it's not an advisable structure to put because when there's no succession plan there. But when you have bought, for instance, assets and you've put it in a company, the company doesn't die. When you die, the company doesn't die. All they have to do is just transfer the shares of the company into your beneficiaries. And then that's it. The cost of transfer, it's just legal cost, nothing more than that. As opposed to having to wind up an estate, it attracts estate duty, it attracts capital gains tax, it attracts your executors fees. So there's all these costs that are taken into consideration when they're winding up your estate under your personal capacity. But as opposed to when your assets are sitting in a company, your assets are sitting in a trust. The trust, as long as it's still registered, it does not die. It's not a natural person, so it does not die. So it survives after your death. So even after your kids, when they died, it also survives them. So it's better to put your assets under a company or under a trust, or even both, because even post your lifetime, they can still survive. Those two structures, they still survive, and your kids and your beneficiaries or your dependents can still continue to benefit from that, without having to incur a huge debt tax burden on them post your death.
Okay. I think let's be a little bit more practical, Lebo, because I think for some other people, they might hear this and they're like, this might not affect me, right? The reality is, brah, you're going to die, right?
Yeah.
COVID is here. I don't know the stats around COVID. I haven't been looking at it because I haven't been wanting to get scared. So I haven't been looking at the negative news. But let's zoom into a property. Lebo, I'm just going to give an example here. We've got a property here. I own the property. I've got 2 kids. That property is an investment property that I own for R1 million. And maybe I've got a bond on it for 600,000 by the time I die. And it's in my personal capacity, right? What are the baby steps of what is going to happen from a tax perspective on my investment when I die?
So you have a property, it's R1 million.
Yeah.
It's owing 600,000.
100%.
On your debt. So the first thing that they do, your executors, what they'll do is they first have to settle your debt.
Right.
So so they take your whole estate, combine all the assets that you have, cash and otherwise, and gather all the liabilities that you have in your estate.
Right.
And then they have an obligation to settle first your liability before they can distribute your assets. So chances are, when you die, they're going to lose that property because it's going to be sold first to settle the debt, then the remaining balance, then obviously it attracts your executives fees. If there's any capital gains, there's capital gains tax, and then the remaining balance, only that is redistributed to your beneficiaries. But if you have that in a company and that asset is generating income, so what they will have to do is just to continue with the company. The company will still continue servicing the bond, and then they just eat out on the profits.
I think it's very important there, Lebo, to clarify that, because I think at a lot of times we miss the fact that myself as an individual, I'm an entity. I'm seen from a SARS perspective that yes, Tarai, flesh and blood, he's an entity on his own.
Yes.
The company is an entity on its own as well, right? And even though I might own the company, but these two are separate. They are separate entities that have different rules and regulation from a tax perspective on how they should be run. And when an event happens, death is an event. When an event happens like death, again, they are treated differently. There is different boundaries. However, I still have kids And I'm doing all of this for myself now to put food on the table, but I'm also doing it for the future generations that is coming there. And by me buying this property on my name, Label, you saying that from a tax perspective, I'm not utilizing the structures that are there to my benefit and to my generation benefit.
100%, 100%.
The alternative could be a company, which we have just explored now, because it can continue living on.
Yes.
Right? Because it's a separate entity. What about if I had bought the same property in a trust? Because we always speak about buying it myself, buying it in a company, or buying it in a trust. In this case now, there's a trust involved. What's the scenario there? Again, on the same amount of monies.
The scenario is still the same. When you pass on as the owner of the trust, or the person that set up the trust as a trustee, so these because the trust will survive when you pass on.
Right.
When the event of death happens, the trust continues to live on. Now, the only thing that will happen is that if you are the only trustee on the trust, then they'll have to appoint a new trustee, and your kids will continue. If they were beneficiaries prior to your death, they will continue to be beneficiaries. If they were not, you are the only beneficiary of the trust, then they will have to add them as beneficiaries of the trust, but it will continue to live on and still continue to operate the same manner that it was operating.
Right. Okay. I think thanks for that, Lebo. And I want to come back. I want to kind of like give a different scenario here.
Yes.
And Lebo and I, we had the conversation around, so which structure is good for you in one of our previous videos. And I think the idea here is to joggle your mind to say, what are the repercussions if you don't do this intentionally? But now, Lebo, I've started. I've got this one property, it's in my name, or maybe 4 of them are in my name. And I'm hearing what we're talking about for the first time here.
Yes.
What should I do? Should I stop buying? Should I continue buying? What do I do with the ones that I've got now, in terms of for me to reap the benefits of from a tax perspective?
So I think there are a couple of options that you can explore in terms of transferring the properties from your name, right?
Yeah.
So if for instance, so depending on if you bought cash or you've bonded the properties.
Right.
So if you bought cash, that's easy. You just do the transfer. The transfer is normal. You pay transfer fees, and then that's it. They're now sitting in a company.
Yeah.
Then if you bought in your personal capacity and your company doesn't have revenue, obviously you just need to apply a certain structure that will allow the company to start generating income, and then you apply you can just apply for a substitute bond on the properties, and then you still become the surety of those properties or that company. So there's different structures and methods that you can apply in order for you to continue with the benefit. Because if all the properties are sitting in your personal capacity, remember as well, it attracts, if you're generating income from those properties, you now have to declare that income to SARS, of which it pushes up your tax bracket, and you are taxed at the highest tax rate in the country, which is up to 45%. But what else, if they were sitting in the company, a company can only be taxed up to 28%, nothing more than that. And it's taxed at net profit. Whereas on your personal capacity, you are taxed at gross. Your total income that comes in, that's where Mr. SARS comes in. And then you are, whatever is left, you can spend. In a company, you get your income, you spend first, and then you are taxed. So those are the benefits to say, look, instead of I've received $1 million in my personal capacity, then SARS says I want 45% of that, which is 450,000 before you can spend. But at the same time, when you have a company, now you receive R1 million, you spend first, then whatever is left starts taxed at 28%. So those are the two benefits. Those are the two different things and different methods that you can apply in order for you to benefit from the tax perspective, and order for you to ensure that post you are being on this earth, then your legacy is still continuing. Your children are still continuing to benefit. Your wife, your family still continue to benefit, and the community, if you are supporting the community, it still continue to benefit from the wealth that you have created.
100%, and hopefully no Ben 10. Now, you know, we always read about the stories of the rich wives, you know, that they are now in the Bahamas and what, and they are with some Ben 10 somewhere. I'm always teasing my wife to say that, baby, if I die, are you going to marry some Ben 10 somewhere? I just want to know before I die. But on a serious note, there we are, right? I think I want to make it clear here that we are advocates of these things because we are doing it, right?
Yes. Yes.
And we're also seeing other people in the communities that have passed on, and now, you know, when the husband was there or when the wife was there, life was good, you know, and the one partner dies, and who was the breadwinner or the thinking engine of the businesses, and things just went bad. I mean, all of us, I think we can relate to that. We have seen these people in our neighborhoods, you know, but what we're trying to do here is to educate me and you that it can be done properly, but how do you do it? So number one, we're not saying that you mustn't buy properties in your personal name. That's not what we are saying, because your circumstances could be different, right?
Yeah.
So for instance, for me, I don't earn a lot of money in my business. I don't, right? I earn very little in my business. So from a SARS perspective, I'm kind of like zero, right? So if I get like a deal, one or two coming by.
So you like Trump?
I didn't say that. I just learned from the best. Learn, implement.
Yes,
right?
yes, true.
And if I get a 200,000 deal, like for instance, right now, Lebo, there's a deal that came through for 200,000, and can I do it in my personal capacity? If it's a good flip, you know, I don't normally do flips, but if it's like that, I can do it, because from a tax bracket perspective, there's nothing.
Yes, yes, yes.
Right, but then we throw in the same scenario with someone else who's an executive somewhere at the bank. They can't do that deal on their personal capacity. Well, they can, but they might lose out on their profits, isn't it?
Yeah, they can, but though obviously the income is now taxed at their tax bracket, or even higher, because sometimes the income, when you get the income, it pushes your tax bracket higher than you tax at the highest tax bracket. So and then in rare cases, then you get your income but they just tax it at your current tax bracket.
Yeah. What is, and we've spoken about this level, what is your favorite structure, go-to structure that is very tax efficient? And the reason why I'm asking Lebo this question is that I know that he's going to answer me with variables. For me, I've got a go-to structure.
Yeah.
And depending on the deal, I can work it through. But for me, I do all my businesses in one company, right? So I don't have like different businesses. But Lebo, you are different from me. You are your own or your own boss. I've got partners, I've got shareholders to report into, things like that. So transparency in terms of the deals that I'm doing is very high in my business. It's something that I have decided to do. I'm a rare individual compared to many people out there, because they could just be doing one or two deals in their personal capacity or with their families, right?
Yeah. Yeah.
My go-to structure, and when I spoke to my guys, I spoke to my tax practitioner, I spoke to my structuring guy, and is that my kids, myself, my wife, and the people that are loved ones to me, including my mom, all of those people are beneficiary in my trust. Okay, that's number one, step number one. Step number two, I'm also a trustee in that trust. Then step number two is that my trust then owns shares of the company. So I've got one company that I do business in. And my shares owns that company. I am a manager in that business. I don't own it because the trust owns it, right?
Yeah.
I'm a manager in that business. And out of that, what I do now is I get an income. I still get paid because I'm a manager, I'm an employee, right?
Yeah.
But I'm working also in that business to invest, right?
Yeah. Yeah.
Any other business that I then do, right? Let's assume that my holding company is ABC. Any other business, if I do a joint venture with Biz House, it's no longer a joint venture with me, it's a joint venture with ABC with Biz House.
Yes. Yes. Yes.
And that's my preferred, but my sister can come up with some deal there. Yeah, if it works out, we can do that deal easily in my personal capacity because it's a very small deal. I prefer not to own anything because from a tax perspective, I've learned from you, Label, from all the businesses that I've done, all the other people, I should own nothing but control everything.
Yeah. Yeah.
What's your
Yeah.
view on that?
Same here. I've set up a trust as well that I'm also a beneficiary and a trustee on it. I have other things that I'm supporting, community services that I'm doing, CSI services that I'm doing through the trust. I have Biz House. I think this is the mainstream of my business. So I do most of the things through Biz House. Biz House owns shares in multiple companies. So I do most of my business because I am fully operating from Biz House. I wake up every single day to just go run Biz House.
100%.
So most of the deals that we do, so the partnerships, the JVs that we do it through Biz House. Yes, I am the founder and CEO of Biz House. I am the main guy in Biz House in terms of shareholding. But now I have, when it comes to the JVs and then the Biz House will also be the shareholder in those entities, in those JVs. And from time to time, I mean, if my banker says, "Hey, look, there's a, you can, there's a," if I call my banker and I say, "Look, there's a deal that just came through to my desk. What can we do?" And they say, "No, look, your personal capacity, you're good. We can give you that. I'll take it any day. I'll take it." And we are also how I've structured my business is I've structured my business to a point, in a sense that I wanted to get to a point where we can buy, multiple properties all at once, without having to, when you're doing it in your personal capacity, you need to wait. If you're only doing it in your personal capacity, you need to wait for like 3 months, 6 months for in order for you to reapply for finance. But if you put down all these structures in place, then you are able to buy multiple properties as and when a good deal comes by, you are able to grab it using different entities at that particular point without having to wait or waste any time. Because sometimes you wait and then the deal passes you by because you don't have access to the funds.
100%.
Yeah.
In closing, Lebo, I want to ask you the question. We've spoken about this. We have spoken about what can happen.
Yes.
And what will happen to all of us.
Yeah.
And we have given scenarios of this is how you can solution it. What are the practical steps that one can literally take today for them to start having to create their wealth creation plan? Who do they need to consult? Because none of us structuring people here. Where do they need to go? I mean, can they just do a copy and paste, go and buy a trust and have a company because TJ and Lebo said they have them, so we should also have them?
I think, look, I don't think there's any size one fit all structure in this world, right?
High five.
So so as I always say, look, even when people I post something and they say advise me, I can't just advise people based on thumb sucking and say where's the wind blowing and advise them based on that. Obviously, you need to for one to be able to advise, they need to analyze your situation, your financial position, your goals, your dreams, your aspirations, where you are, where you want to get, where you want to be, and how do you get there, So, and that is different for each and every individual of us. Yeah. So hence I always say, look, if you want, for instance, based on your question, if you want to know how to structure your estate planning, then I'd recommend you go see an estate planner. They are certified and qualified to do so. Or you just consult your legal, your attorney that you work with. They also have a certain amount of knowledge to an extent that can help you, structure from a legal perspective. And obviously, if you're looking for a tax benefit, I'll always recommend you to go sit down with your accountant, sit down with your tax practitioner, sit down with your chartered accountant in order for them to advise accordingly, to give you expert advice, not thumb sucking. Analyze. They'll sit down with you. They will analyze your financial position. They will analyze. They'll get to know where you want to be, where you are, and how to get you there. And then they will advise accordingly. And they'll give you the best advice according to the information that you've provided. But if you just want to take shortcuts and cut corners and try and copy and paste, it might not work because everyone is different. Every scenario is different from another. So consult. So in this case, for estate planning, go see an estate planner. They'll be able to advise you accordingly.
Awesome stuff. If you're really struggling around this area and you are looking for people that are already doing it and things like that, hit us up on an email, info@m5propertyaddicts.com. You will also see the email at the bottom, and we can direct you to people that we are working with, right? And, you can go and consult, and there's always some fees that you might need to pay and things like that. But the bottom line is that they will now help you. It's about you. Me and Lebo are sorted based on our circumstances, right? And I'm just trying to figure out whether there's a way that I can make sure that the Benton cannot withdraw the cash. I haven't figured it out, but I will. Yeah. Okay, good stuff. On a serious note, I think this is, I've really been throwing in this Benton conversation so that we can lighten up the conversation, because this is a heavy conversation label. People don't speak about these things, that you are going to die. Because in our communities, the moment that you start saying you're going to die, it's like, are you the one who's going to kill me?
Yeah. It's like you're playing that death or something. Yeah.
And this is a reality for all of us.
True, true. No one is going to dodge that. And no one is going to dodge this. We all have an appointed time. When
And
it happens,
this is my ambition for us to talk about uncomfortable situations in the property space, so
yes,
that me and you, we can be better people, so that me and you, we can educate ourselves, create the awareness so that we can find the solutions. If Lebo and I don't have the solutions, at least we'll go out there and find the solutions. So
100%.
if there's anything else that you'd like to hear, again, drop us some comments and we'll start digging into those areas. Lebo for me, we only had money conversations with my parents, with my mom,
Yeah,
not even like 3 4 years ago, bruh.
yeah.
Yeah,
I think it's still with me. It's still a bit challenging. Each time I bring the money topic on the table, it's still a bit of a taboo at my parents' house because they say the accountant. They think because I'm talking about finances and financial planning, it's the accountant in me talking. I'm the typical accountant, but it's just for me to educate them and share the light in terms of growth financially. But they don't see it like that. It's like a taboo. It's a
mm.
topic that no one wants to tackle.
I want to throw in something here, Lebo, before we go. And this is something that I do in my house with my missus.
Yeah.
Um, I work for my wife and my kids. Those are my primary shareholders, right?
Yes.
And every month I dedicate a bit of time to take through my wife. I mean, she hears stuff as we talk. My office is at home, and
Yeah.
and I talk about different frustrations, projects, what not working, things like that. So she kind of like knows, right? But she's not in my business, right?
Yeah. Yeah.
But I spend at least about 15 to 30 minutes, sometimes even like 2 to 3 hours, explaining to her where my business is.
Yes. Yes.
Financially, where are we? You know?
Yeah.
Because at the end of the day, I'm working for her. She's the boss,
Yeah. Yeah.
right? And out of that, I put that on top of mind on my diary. It is there. I know that we're going to have this conversation. I prepare for it so that I can show her numbers. I can show her printed stuff. I can tell her we're going into this project. This is what it's going to mean. A, B, C, D. And the idea is that my wife knows exactly where we are financially. And together we are stronger in making the decisions that we need to be making in our household,
Yeah.
because we
Yeah.
can see that Mauritius trip coming through. We can see that buying that new house, we can make an informed decisions of buying I don't know what car that it is, because together we know exactly how much money we're coming in, and we can
Yeah.
afford to go and buy Woolies food for that week because we know
Yeah.
how much money is there. And why we are buying a Checkers, by the way, I'm not making a comparison of Woolies and Checkers. But all of a sudden we've been buying a Woolies, and why have we downgraded to Checkers if it is
Yeah.
downgrading at all?
Yeah.
Um,
Yeah.
and 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 these are conversations that we need to have as husband and wife, because if we're not
100%.
having those conversations as a husband and wife, how can we now have the same conversations with husband, wife, kids?
Yeah. Yeah. So this is what I do in my household with my wife, right?
Yeah.
So from the word from the beginning, when I met my wife when I was still a typical accountant, right?
Mm.
So I had said I've laid ground rules in terms of finances from the word go, even when we
You're
started
making it
dating.
sound serious. You laid ground rules.
I remember even our first trip to Devon with her. I gave her a budget to say, look, we're going. This is the budget.
Yeah.
And I remember the night we were coming back, the budget was left to the 100 rand, and that's all we spent, and nothing more than that. And she said, I said to her, we're out of budget. And she's like, okay. And then on the way, she wanted something else. I said, but the budget is over.
Yeah, you're a typical accountant. I feel pity for your wife.
So,
But,
but
but I
that
think,
was a good foundation for her, because she didn't come from a background where money is a topic.
sure.
So I started making those conversations to a point where when we were planning now our future, so we had targets to say, look, we target to increase our income to this extent, but
Right.
now we target to decrease our expense to this extent so that we can spend less than, so our expenses should be less than 20% of what we earn. So that's the target. So now we're targeting to get it to 10%, and then
Right.
increase. So we're increasing the income
Yeah.
to a point where our expenses are at 10%. And then we can bring back the lifestyle at 20%. Then work like that, increase the income to a point where our current expenses are at 10%. Then we can double our lifestyle. So those are the conversations that we've always been having with my wife to say, look, this is where we are. This is where we need to get to first before we can even consider buying a new house. Going on a 7-star holiday trip, or all those type of things. So in terms of lifestyle, those are the conversations that we have to say, look, let's increase our income first, then we spend. Increase first, then we spend.
I think the bottom line is that if you can even find time to have those conversations, you can speak about anything, right? For
100%.
some other people, they find time to speak about anything, but they never speak about finances.
Yeah.
But yeah, it's been a good chat. Lebo, you want to sign out, brah?
Yeah, guys, I think the most important thing to take out of this is that you must live your life intentional. Don't do things by accident. Nothing in this life happens by accident. So if you let your life have to happen by accident, everything in your life will be an accident. So we don't want disaster happening in your life. That's why we're having these conversations to say, look, plan your life and execute and stick to your plan, and consult the relevant people that will help you to get to where you always want to be. But take out of this to say, plan, get the knowledge, and execute. Thank you guys. We'll catch you in the next video. Take care.
Awesome stuff. Boom.